EBITDA. You've seen it in board decks, job descriptions, M&A headlines. Your boss asks for it every month. But what does it actually mean? And why do investors, banks, and acquirers care so much about it? In the next 5 minutes, I'll break it down in plain English, give you a real example, and show you why it matters more than you think. This is the faceless CFO. Let's go. Pause. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Let me unpack that. Earnings means profit. Before interest, that strips out how you finance the business. Before taxes, that removes the effect of which country or jurisdiction you operate in. Before depreciation and amortization, that removes the non-cash accounting charges for long-term assets. What's left is your core operating profit. The money your business generates from actually doing its job, before the accountants and bankers get involved. There are two ways to calculate it. Top down. Start with revenue. Subtract cost of goods sold, subtract operating expenses, but exclude depreciation and amortization. That gives you EBITDA. Bottom up. Start with net income, then add back interest, add back taxes, add back depreciation, add back amortization. Same number, different starting point. Pause. Let me show you with a real example. A company with $1 million in revenue, $400,000 in cost of goods sold, $300,000 in operating expenses, salaries, rent, marketing, revenue minus COGS minus OPEX. 1 million minus 400 minus 300 equals 300,000. That's your EBITDA. EBITDA margin is 30%. Now, this same company also has 40,000 in depreciation, 20,000 in interest expense, and 48,000 in taxes. Net profit equals 300,000 minus 40 minus 20 minus 48 equals 192,000. Same company. Two very different numbers. EBITDA is 300,000. Net profit is 192. Which one is right? Both. They answer different questions. EBITDA tells you, how much operating profit does the core business generate? Net profit tells you, what's left after everything is paid? Pause. So why does EBITDA matter so much? 4 reasons. Number 1, M&A valuation. Companies are bought and sold based on EBITDA multiples. The middle market average is 7 to 8 times EBITDA. So that $300,000 EBITDA multiplied by 7.5 equals $2.25 million in enterprise value. Every single dollar of EBITDA you add is worth $7 or more in company value. That's why CFOs obsess over it. Number 2, comparability. EBITDA strips out financing, taxes, and depreciation policies. That means you can compare a company in Hong Kong to one in Singapore to one in New Zealand on equal terms. Different tax rates, different debt structures, different asset bases. EBITDA neutralizes all of that. Number 3, debt capacity. Banks use EBITDA to decide how much they'll lend you. The typical ratio is 3 to 4 times EBITDA. 300,000 EBITDA means you can borrow roughly 900,000 to 1.2 million. Number 4, operational focus. EBITDA shows management performance without the noise of capital structure decisions. Did the CEO grow the business? Did the COO cut costs? EBITDA answers that, without being distorted by how many loans the company has or what depreciation method the accountant chose. Pause. Now, the dirty secret. EBITDA has real limitations that most people don't talk about. Limitation 1. It ignores capital expenditure. A manufacturing company spending $500,000 a year on equipment has very different cash needs than a software company spending almost nothing. EBITDA treats them the same. They're not. Limitation 2. It ignores working capital. If your cash is trapped in accounts receivable, EBITDA doesn't show that. You can have great EBITDA and still run out of cash. Exactly like Meridian Tech in our last video. Limitation 3. It can be manipulated. Aggressive revenue recognition, recording revenue before it's truly earned, inflates EBITDA without any real cash changing hands. Warren Buffett put it best. He said, "Does management think the tooth fairy pays for capital expenditures?" His point: you can't ignore the cost of maintaining your assets just because it's convenient. The fix? Always pair EBITDA with free cash flow. Free cash flow equals operating cash flow minus capital expenditures. EBITDA tells you operating power. Free cash flow tells you what's actually available to distribute, reinvest, or save. Pause. Quick reference. EBITDA margins by industry. Software and SaaS, 20 to 40%. Telecom, 25 to 40. IT services and consulting, and 14 to 22. Healthcare and pharma, 15 to 25. Manufacturing, 10 to 15. Construction, 8 to 12. And retail, 5 to 10%. Context matters. A 15% EBITDA margin is excellent for a retailer, mediocre for a software company, and impossible for an airline. Pause. EBITDA is powerful, but incomplete. Use it for comparisons and valuations, but always check free cash flow to see the full picture. I've put a free EBITDA calculator and margin benchmark template in the description. If this made EBITDA click for you, hit subscribe. New videos every Tuesday and Friday. Drop a comment. What financial term do you want me to explain next? I read every comment. Next video, DSO, DPO, and the cash conversion cycle. The CFO's cheat sheet. See you there.